let's work through the chapter 19 and 20 review. So question number 1, we're told that Lopez Corporation incurred the following costs while manufacturing its product. We're given a long list of costs here, right? We're also told a work in process inventory amount for the start of the year and the end of the year, as well as a finished goods inventory amount for January 1st and December 31st. Then our sales revenue for the year was $900,000. Using all of that information, we can figure out our cost of goods manufactured, then our cost of goods sold, and then we can prepare an income statement through gross profit. So before we work on figuring out our cost of goods manufactured, let's look back up at all of our costs at the top of the screen. And let's go through and say whether they're a product cost or a period cost. And if they're a product cost, then whether it's direct materials, direct labor, or manufacturing overhead. Right? So materials used in a product. That's going to be a product cost, and it's going to be direct materials. Depreciation on the plant, that's depreciation on the factory building itself. Right? So that's going to be your manufacturing overhead. Property taxes on a store. So that's a cost outside of the manufacturing process, right? That's the store. So that's going to be a period cost. Then labor costs for assembly line workers. Well, that's direct labor. Factory supplies used. That's inside the factory, so it's a manufacturing overhead cost. Advertising expense. That's outside of manufacturing, so that's a period cost. Property taxes on the plant, this is manufacturing overhead, right? When it was on the store, that's a period cost because it's outside of the factory. Here, it's on the factory itself, so it's manufacturing overhead. Then delivery expense, that's going to be a period cost. Salaries paid to sales clerks is a period cost, and sales commissions will be a period cost. Now that we have all that figured out, we can work through our cost of goods manufactured schedule. So you can see the first line is work in process on January 1st. Well, we were told that that was $12,000, so we'll just toss the $12,000 in there. Direct materials, that was our $120,000. Direct labor, that was our $110,000. Now, manufacturing overhead, we had 3 separate pieces to that, right? So let's figure out our manufacturing overhead here. We had depreciation on the plant, we had factory supplies used, and we had property taxes on the plant. So we're going to want to add all of those together to get our total manufacturing overhead. That's going to be $97,000. So we'll take this $97,000 and we'll toss it in to our cost of goods manufactured schedule. Now your total manufacturing cost will be your 3 product costs added up. So direct materials plus direct labor plus manufacturing overhead. So that will give us $327,000. Now your total cost of work in process will be your beginning work in process plus your manufacturing costs. So that comes out to be $339,000. Then we need to subtract out our ending work in process, right? Our work in process for December 31st. We were told that that was $15,500. When we subtract that out from our total cost of work in process, we get a cost of goods manufactured to be $323,500. So now that we figured out the cost of goods manufactured, we can now use that to compute our cost of goods sold. So our formula that we're going to use here is beginning finished goods plus cost of goods manufactured minus ending finished goods. Now there's different wording here compared to how you figured out cost of goods sold back in financial accounting, but the idea is still there. We're taking beginning inventory plus everything that we manufactured compared to everything that we purchased when we were still in financial accounting. And then we subtract out our ending inventory. Right, so the general idea is still the same, but since it's a manufacturing company, it's going to be calculated a little bit differently. So we plug in our numbers that we have here. So beginning finished goods was 60,000 plus the cost of goods manufactured that we found minus our ending finished goods of 45,600 gives us a cost of goods sold of 337,900. Now that we found a cost of goods sold, we can now prepare an income statement through gross profit. So to find your gross profit, you take your sales and you subtract out your cost of goods sold, right? So we were told at the beginning of the problem that our sales were $900,000. We want to then subtract out our cost of goods sold of $337,900. We just found that in the last part. And that gives us a gross profit of $562,100. Now question number 2. St. Clair Decorating uses a job order cost system to collect the costs of its interior decorating business. Each client's consultation is treated as a separate job. Overhead is applied to each job based on the number of decorator hours incurred. So we have some information here. We have estimated and actual overhead amounts and estimated and actual decorator hours. Using that information, we will be able to compute the predetermined overhead rate, determine the applied overhead for the year, and figure out whether the overhead was under or over applied and by how much. So let's first talk about the predetermined overhead rate. So to find this rate, what we're going to do is we're going to take our estimated overhead and divide it by our estimated decorator hours. Now we'll always use our estimated amounts here. Think of it as you're trying to figure out this predetermined overhead rate at the beginning of the year, right? And at the beginning of the year, you don't know your actuals yet. So we have to use our estimates. So our estimated overhead was 960,000. Our estimated decorator hours were 40,000 hours. So our predetermined overhead rate will be $24 per decorator hour, meaning that for every single decorator hour, we are expecting to incur $24 of overhead. Now we can figure out our applied overhead. So we're going to take that predetermined overhead rate that we just found, and we're going to multiply it by our actual decorator hours. So our $24 per hour times 40,500 hours, because that was our actual hour amount. And we can find our applied overhead to be $972,000. Now that we have our applied overhead, we can figure out, was our overhead under or over applied? So we take our actual overhead of $982,800 and we compare it to our applied overhead of $972,000. We'll take the difference to see that it's $10,800. Now, was it under or over applied? So we take a look back at our actual versus applied overhead amounts. Since our applied overhead is less than our actual, this is under applied. Let's say our applied overhead was $1 million. Then, since our applied would have been greater than our actual, it would have been over applied. Now question number 3. Kelly Company identifies 3 activities in its manufacturing process: machine setups, machining, and inspections. Estimated annual overhead costs for each activity are $150,000, $325,000, and $87,500. The cost driver for each activity and the expected annual usage are 2,500 setups, 25,000 machine hours, and 1,750 inspections. And we need to compute the overhead rate for each activity. So if we show this in a table form, it might be a little bit simpler. So we have our estimated annual overhead and our cost driver for each of these. What we're going to do to figure out our overhead rate is take our estimated annual overhead and divide it by its corresponding cost driver. So for machine setups, we take $150,000 divided by 2,500 setups, and we get an overhead rate of $60 per setup. Now machining, we take our $325,000, divide it by our 25,000 machine hours to get an overhead rate of $13 per machine hour. And now for inspections, we take our estimated annual overhead of $87,500 and we divide it by 1,750 inspections. That will come out to be $50 per inspection. So in the last problem, when we just had the $24 per hour overhead rate, that was kind of a general sense, right, for the entire company. Here, when we figure out the overhead rate for each activity, we can break it up a little bit more and be a little bit more exact, right? So every time that there's a machine setup, we're expecting $60 of overhead. Every time there's an inspection, we're expecting $50 of overhead, right? Rather than combining them all and just having one general overhead rate.